Everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss two very important finance current affairs that is quite in news recently. So the first one is regarding the Lok Sabha sends the Corporate Laws Amendment Bill 2026 to JPC, that is the Joint Parliamentary Committee. So we will discuss that what is this Corporate Laws Amendment Bill 2026, how it has been sent to the JPC. Okay. The next news article that we have to discuss is regarding the retail inflation target, okay, that has been stated for the period of 5 years. So what is the background regarding the inflation, the flexible inflation targeting? We will discuss when will it be considered that the RBI has failed to follow the inflation target. So all of this we are going to discuss in today's session, and the important facts are going to be discussed in today's session. What you have to remember, I will inform you. Okay, so these both news articles, they are important from the RBI Grade B examination point of view for the phase 1 and from the phase 2 perspective. Okay, so we will discuss that what are the important facts that you have to keep in mind. So give me a thumbs up if I'm clearly audible and the screen is visible. Good morning Kashish, good morning Akshu. So give me a thumbs up if I'm clearly audible and the screen is clearly visible. Okay, so now let's get started, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay. Okay. So I think I'm clearly audible. Now, let's move forward with the first news article that we have to discuss. So the Corporate Laws Amendment Bill 2026. So what has happened that the Corporate Laws Amendment Bill 2026, this was introduced in Lok Sabha on March 23rd, 2026, and there are a lot of news articles that are going on related to the Corporate Laws Amendment Bill 2026 because there was a big discussion in the Lok Sabha regarding this bill. Okay, so now the Corporate Law Amendment Bill 2026, it was introduced in Lok Sabha on March 23rd, and it was decided that this bill will be sent to the Joint Parliamentary Committee. Okay, so on the same day in the Lok Sabha, it was decided that this bill will be sent to the Joint Parliamentary Committee, which will give the detailed analysis regarding this bill. Okay, why this particular bill has been sent to the Joint Parliamentary Committee? Because there were a lot of discussions that were happening around this bill. There were a lot of objections that were regarding this bill. Okay, but the finance minister of our country, that is Srimati Nirmala Sitharaman, said that already 2 years have been taken to bring this amendment bill, and this amendment bill has been brought with a detailed discussion with the different market players. Okay, so basically the government wants to bring this bill, but there were a lot of objections from the opposing party, and that's why this bill has been sent to the Joint Parliamentary Committee. Okay, that will have to provide its detailed analysis on the bill soon. So before the examination, if the detailed analysis has been released, if the recommendations are being released and the bill passes, then this will become very important for your phase 2. Right now, this is more important from the phase 1 perspective. Okay, so the Corporate Law Amendment Bill 2026 was introduced in Lok Sabha on March 23, 2026. Now, the Corporate Law Amendment Bill 2026, it seeks to amend the Companies Act 2013 and the Limited Liability Partnership Act 2008. Okay, so the Corporate Laws Amendment Bill 2026, this is a bill that was presented, that was introduced in Lok Sabha on March 23rd, and now it has been sent to the Joint Parliamentary Committee, which will soon provide its detailed analysis. Okay, that's why this becomes important, because the Joint Parliamentary Committee is involved, that is going to provide its detailed analysis in the monsoon session, that is soon. So this is the idea that the Corporate Law Amendment Bill 2026, it amends the Limited Liability Partnership Act of 2008 and the Companies Act of 2013. Now let's get started with the key amendments under the bill. First, we are going to discuss the key amendments for the Companies Act 2013. Okay, so see, the biggest objection that has been presented is against this particular part, that is the corporate social responsibility. So the bill wants to change a certain criteria of the corporate social responsibility, but there were a lot of objections from the opposing party. So now, what is this corporate social responsibility? So the corporates, the companies, they basically have the responsibility to provide a certain percentage of their average net profit for the social benefit. Okay, so the corporates, the companies, they have the responsibility to provide certain percentage of their net profit for the social benefit. So corporate social responsibility. So under the Companies Act 2013, the companies meeting either of the following criterias, thresholds, they are required to contribute at least 2% of their average net profit in the last 3 years towards the corporate social responsibility policy. So basically, the companies that are meeting any of the threshold, these companies, they have to provide 2% of their average net profit that they have earned in the last 3 years. So 2% of that they have to provide for their corporate social responsibility. So if the company has the net worth of rupees 500 crores or more, if the company has the turnover of rupees 1000 crore or more, or if the company has the net profit of rupees 5 crore or more in the immediately preceding financial year, so if any of this criteria is being followed by a company, then the company has to provide certain percentage, that is 2% of their average net profit for the corporate social responsibility policy. Okay, now what is the change that is proposed by the bill? So the key amendment under the bill is that the bill changes the net profit threshold to rupees 10 crore or such other sum that may be prescribed by the government. Okay, so this is the particular criteria that has been changed, that rather than net profit of rupees 5 crore or more in the immediately preceding financial year, the new criteria will be the net profit of rupees 10 crore or more or such other sum as may be prescribed by the government. So there is also flexibility that is provided for the government to change this criteria further. Now there was the major discussion that happened around this point, that if the net profit threshold is changed, so basically the government is trying to remove this CSR. So the government or the finance minister Srimati Nirmala Sitharaman clarified that we are only changing one of the criteria, the other criterias have not been changed. Okay, so this criteria is particularly being changed to help the small companies, because let's say that the small company, it does not have the net worth of rupees 500 crore or more, the turnover is also not 1000 crore, but the small company is following this particular criteria of net profit of rupees 5 crore or more in the immediately preceding financial year. So it might be a small company and we are pressurizing the small company to follow the CSR policy, to follow the corporate social responsibility policy. So the government said, the finance minister Srimati Nirmala Sitharaman said that this particular criteria is being changed, okay, to help the small companies out. So this is the idea. Now coming to the next key amendment. So here in the first amendment, remember that the net profit threshold has been proposed to be changed to 10 crore or more or such other sum as prescribed by the government. Okay, next is the scheme of merger or amalgamation. So the act specifies, the Companies Act 2013, it specifies approval requirements for merger or amalgamation of certain companies, such as between two or more small companies. So if there is a merger or amalgamation that is happening between two or more small companies, or let's say there is merger or amalgamation that is happening between a holding company and its wholly owned subsidiary company, in this case there is certain approval that is required. So in case of merger and amalgamation, there are certain approvals that are required. What are the approvals? So a scheme of merger or amalgamation must be approved by respective shareholders holding at least 90% of the total shares. So this was the criteria before. Now the bill that is the Corporate Laws Amendment Bill, it modifies or it proposes to change this threshold to 75% of the total present members and voting members. So basically what is happening, that before it was said that if the merger and amalgamation has to happen between these entities, then this merger or amalgamation must be approved by respective shareholders holding at least 90% of the total shares. Now the bill proposes to change this threshold of 90% of the total shares to approval of majority of members that are present and that are voting. So only the members that are present and that are voting, only those shares that are present and that are voting in the meeting for the merger and amalgamation, only those shares will be considered. Okay, so it has been said that the members that are present and voting who hold at least 75% of the shares among the members present and voting, so 75% of the shares of the members that are present and voting. So this is the new criteria that is proposed by the bill. So before, the criteria for the merger and amalgamation approval was that 90% of the total shareholders, they should agree, or 90% of the total shares holding entities, they should agree. But now it has been said that 75% of the shareholders, 75% of the shares among the members present and voting, they should agree. So 75% is the new criteria, and this should be agreed by the members that are present and voting. If the members are not present, they are not voting, then their shares will not be counted in this threshold. Okay, so that is the idea. Next is the bill also reduces the threshold of approval from the creditors. So let's say that multiple entities have given credit to a particular small company that is under the merger and amalgamation policy, or that is under the scheme of the merger and amalgamation. So multiple creditors have given the credit to this small company. Now this small company wants to do amalgamation with another small company. Okay, so before it was said that 90% of the credit value that has been given, so those creditors, they have to agree for this amalgamation or merger that to happen. Now it has been said that this threshold has been reduced from 90% to 75%. Okay, that is the idea. So for the scheme of merger or amalgamation, if two or more small companies, they want to do the merger or amalgamation, or let's say a holding company and its wholly owned subsidiaries, they want to have the merger or amalgamation, there are certain approvals that are required. Before, it was 90% of the total shares that are held by the shareholders, they should agree, but it has been proposed to change to 75% of the shares of the members that are present and voting. Okay, before 90% of the credit value holding creditors, they should agree, but now it has been reduced to 75% as per the proposal under the bill. Any confusion? Anyone? Next is small companies. See, the small companies criteria is also proposed to be changed. Okay, so under the Companies Act 2013, a small company is a company with paid up share capital not exceeding rupees 50 lakh or higher prescribed amount by the government, but higher prescribed amount, it should not exceed rupees 10 crore. So basically, the small company is a company with the criteria, the small company is the company that is with the criteria that its paid up share capital, the share capital not exceeding rupees 50 lakh. But if the government wants for the class of companies, for a particular class of companies, for a particular segment of companies, the government can also prescribe the higher amount, but that should not exceed 10 crore. Okay, so basically for the small company, paid up share capital not exceeding 50 lakh or higher prescribed amount that should not exceed rupees 10 crore, and turnover that should not exceed, the turnover, it should not exceed rupees 2 crore or higher prescribed amount by the government can prescribe a higher amount for a particular class of companies, but it should not exceed rupees 100 crore. That means even the highest turnover, it should not exceed 100 crores if the company has to be classified as a small company. Now the bill is increasing the upper limit for both the criterias from 10 crore to 20 crore for the paid up share capital, and from 100 crore to 200 crore for the turnover. Okay, so this is the idea that the lower limits, they are still the same, that the paid up share capital should not exceed 50 lakhs and the turnover should not exceed 2 crore. But if the government wants to prescribe the higher amount, the government can prescribe the higher amount, but it should not exceed 10 crore for the paid up share capital, it should not exceed 100 crore for the turnover. But these upper limits are being modified under the bill. They are proposed to be modified from 10 crore to 20 crore and from 100 crore to 200 crore. Okay, so these are the major changes that the government is trying to bring. So the small company means a company other than a public company that is having the paid up share capital of which does not exceed 50 lakh rupees or a higher or such higher amount as may be prescribed by the government, which shall be not more than 10 crore rupees, which shall not exceed 10 crore, and the turnover should not exceed 2 crore. Okay, does not exceed 2 crore or such higher amount as may be prescribed, which shall not be more than 100 crore. But these upper limits are proposed to be changed. Now coming to the next point, that is compliances. So the bill, it seeks to simplify certain compliances. A company may hold its annual general meeting physically or through video conferencing or other audio visual means, either wholly or partly. That means some members can be present physically while other members might join through the audio visual form or through the video conferencing, or maybe the whole meeting can happen through the video conferences. But every company shall hold its annual journal meeting in physical mode at least once in every 3 years. So once in every 3 years, there should be a compulsory physical mode meeting that is there. Okay, so it has been said that the company may hold its annual general meeting physically or through the video conferences, but at least once every 3 years there should be the general meeting that should happen in the physical mode. As well as under the bill, there is also it has been proposed to replace certain affidavits with self-declaration, as well as for certain class of the companies it has been said that if they are following certain prescribed criterias laid down by the government, then they will not have to have the annual auditor and such. Okay, so this is the idea that there are various compliances that are being simplified. Okay, so the bill seeks to simplify certain compliances. Next, buyback shares. Buyback of shares basically means that the company sold its shares in the stock exchanges, but now the company wants to buy back its shares or wants to buy back its securities from the shareholders, from the holders, or from the investors. Okay, so basically buyback under the Companies Act 2013, a company may purchase its own shares or other specified securities. So basically the company is buying back its shares, buying back its different securities. Okay, so it was previously said that the buyback, it must not exceed 25% of the aggregate total paid up capital and free reserves of the company. The bill adds that for the prescribed classes of companies, for the prescribed section of the companies, the buyback may be up to a prescribed percentage. That means this provides the flexibility to the government to increase the limit also, or to change the limit. So this is the idea that before there was a strict limit of buyback that must not exceed 25% of the total paid up capital and the free reserves of the company. But now it has been said that the government has the flexibility to change the limit for the prescribed classes of companies. Buyback may be up to whatever limit the government decides for the set classes of the companies. Okay, next is valuation authority. So the bill designates the Insolvency and Bankruptcy Board of India as the valuation authority. IBBI will be responsible for granting, for providing, or for renewing the certificate of registration and recognition to the valuers. The valuers are the authority, the valuers are the entities that value the asset that is under the liquidation process or under the insolvency process or under the restructuring process. So valuers, they provide the real value of the asset, so that the asset is not overvalued or the asset is not undervalued. Okay, so this is the idea that the IBPI will be responsible for granting or renewing the certificate of registration and recognition to the valuers that have the responsibility to value the asset, to provide the real value of the asset that is under the liquidation, insolvency process or restructuring process. It will make recommendations, the IBBI, it will also make recommendations to the central government on the formulation and laying down of the valuation standards and policies. It will monitor and enforce that the compliance happens to the rules and regulations, to the standards. Now so these were the changes for the Companies Act 2013. These were the proposed amendments for the Companies Act 2013. For the Limited Liability Partnership Act 2008, what is the proposed amendment that we will discuss? Okay, so Limited Liability Partnership basically means that a legal entity that limits the extent of the economic loss to assets invested in an organization. So under the Limited Liability Partnership, you can understand that there are partners that are investing in a company. Limited liability means that partners have limited obligation, the partners have limited liability. That means their liability is only how much they are investing in the company, how much they are investing in the partnership firm, how much they are investing in the firm. Their own personal assets will not be obligated if the firm is under the insolvency or if the firm closes down, if the firm is under stress. The partners' own assets will not be affected. So limited liability, that means you have the limited obligation. So limited liability partnership basically means that there are different partners that are present and they have the limited liability. If they are investing in the company, only their investment is at the loss. If the loss happens to the company, so only their investment is at the loss. Their personal assets will not be affected. That is the limited liability partnership. So this is the legal entity that limits the extent of the economic loss to assets invested in the organization. Okay. Now, what is the amendment under the bill for the limited liability partnership? Conversion of trust into LLP. So bill provides for conversion of specified trust into the limited liability partnership. So this applies to trusts that have been established under the Indian Trust Act 1882 or any other central or state act, and or they are registered by SEBI or IFSC authority and are engaged in prescribed activities. Okay. So this is the idea, that if there is the conversion that needs to happen of the trust into the LLP, so bill provides for the conversion of specified trust into the LLPs. This applies to trusts that have established under the Indian Trust Act 1882. They are registered by SEBI or IFSC authority and they are engaged in prescribed activities as prescribed by the government. Now, the bill decriminalizes various procedural defaults. So what used to happen, that before, if there is any procedural default, so there can be the fines that can be imposed or there can be the imprisonment that can also happen. So these procedural defaults, they were seen as the criminal basis. But now it has been said that the bill decriminalizes various procedural defaults under the Companies Act and the Limited Liability Partnership Act by replacing the criminal provisions with civil penalties. Okay, so that is the idea. So this is it. The additional information is that after moving the Corporate Laws Amendment Bill 2026 in Lok Sabha on Monday, the Corporate and Finance Minister Nirmala Sitharaman proposed to send the bill to a 31-member Joint Parliamentary Committee. 31 members will be in the Joint Parliamentary Committee to enable further scrutiny and detailed analysis of this amendment bill. The Joint Parliamentary Committee will include 21 Lok Sabha MPs and 10 Rajya Sabha MPs. That will be nominated by their respective chairpersons and make its report on the bill on the last day of the first week of the monsoon session later this year. So soon, in a few, like July, I think monsoon session will start. So in the first week, last day of the first week, that is before your examination, the detailed analysis will be released by the JPC. Okay, if your exam happens in August, let's say, or if your exam happens by the end of July, the phase 1 happens by the end of July. So in the start of July, you will see the report, the detailed analysis of the Joint Parliamentary Committee. So that's why this is important. Okay, we have understood the basics. Now, before the examination, if the report or the detailed analysis is released, you just have to focus on the important points. Okay, so this is the idea, that the bill has been sent to the Joint Parliamentary Committee. Now, coming to the next article that we have to discuss. So, central government in consultation with the Reserve Bank of India hereby notifies that the inflation target for the period beginning 1st April 2026 ending on March 31st 2031, that is for the time period of 5 years, the inflation target will be 4% with the tolerance band of plus minus 2%. Okay, so that means the inflation should not go below 2%, inflation should not go above 6%. So this is the idea, that the inflation target is still 4% with an upper tolerance level of 6%, lower tolerance level of 2%. Now, see, in May 2016, the RBI Act of 1934, it was amended to provide a legal basis for the implementation of flexible inflation targeting framework. Flexible inflation targeting framework basically means that there is an inflation target and there is the band that is provided. That means certain flexibility is provided, that the inflation can go up to 2% or the inflation can go up to 6%. So this is flexibility. The inflation should be around 4%. This is the inflation target. But there is also the tolerance band, there is also certain flexibility that is provided. So the flexible inflation targeting framework was introduced in May 2016. Under section 45ZA, the central government in consultation with the Reserve Bank of India determines the inflation target in terms of the consumer price index. Okay, so inflation target, we have to control the inflation. Which inflation we have to control? The retail inflation, the headline inflation, the inflation that affects the consumers. So that is the consumer price index inflation. So this target, the inflation target is for CPI, the consumer price index inflation, that is the inflation that affects the consumers. Okay, now once in every 5 years this inflation target is reviewed, and that's why it was reviewed recently, and it has been decided that the inflation target will be 4% within the range of plus minus 2%. Now remember that accordingly, first on 5th August 2016, 2016, the central government notified in the official gazette that for the time period of 2016 to 2021, the inflation target will be 4% plus minus 2%. Then it was reviewed on March 31st, 2021. And it was decided that again we are going to follow the inflation target of 4% within the range of plus minus 2% for the coming 5 years of 2021 to 2026. Now in the second review that happened on March 25th, 2026, that is recently the review has happened, the central government has further decided to keep the inflation target same with its tolerance band for the next 5 years, that is from 2026 to 2031. So you can remember that this is the inflation target that has not changed. Now, Section 45ZB of the RBI Act provides for the constitution of the 6-member Monetary Policy Committee. And the Monetary Policy Committee, I think tomorrow, it's the Monetary Policy Committee statement for April 2026 will be released tomorrow, I think. Okay. So remember that the Monetary Policy Committee constitution, it is as per the Section 45ZB of the RBI Act. So New Zealand was the first country to implement the inflation target, the inflation target in 1990. It has become the most widely adopted monetary policy framework globally now. Okay, so New Zealand was the first country to implement such kind of inflation target in 1990. Now, coming to the next part, that is the central government has notified the following as the factors. Now, Monetary Policy Committee is the committee that has the responsibility to keep the inflation target around 4% within the range of plus minus 2%, that is the 2%, 6%. But what if the inflation target what if the inflation is above 6%? What if the inflation is going below 2%? So what will happen? What will happen if the inflation is going above 6% or the inflation is going below 2%? That means MPC has failed. But there is a separate criteria for the failure of the Reserve Bank of India. There is a separate criteria for failure. So central government has notified the following as the factor that constitute the failure to achieve the inflation target. So the average inflation is if it is more than the upper tolerance level. So basically 4% is the target. This is the lower tolerance level. 6% is the upper tolerance level. So let's say the average inflation is more than 6% of the for any 3 consecutive quarters, that is for 9 consecutive months. If the inflation is above 6%, then we will say that the RBI, the Monetary Policy Committee of the RBI has failed. If the average inflation is less than the 2%, the lower tolerance level, for any 3 consecutive quarters for 9 consecutive months, then we can say the RBI has failed, the Monetary Policy Committee of RBI has failed. So this is the criteria for failure. It's not like that today, this month, the inflation target is above 6%, so RBI has failed. No, the time period is 3 consecutive quarters, or we can say 9 consecutive months. So if the average inflation is more than or lower than the tolerance level for any 3 consecutive quarter or 9 consecutive months, then only it will be said to be failure of the Monetary Policy Committee of the RBI. Got it? So this is the idea. When the bank fails to meet the inflation target, it shall set out in a report. Now, what happens if the Monetary Policy Committee of the RBI has failed to maintain the inflation target, to be around inflation target, or to be within the range? What if the Monetary Policy Committee of the RBI has failed? So where the RBI is failing to meet the inflation target, it shall set out in a report to the central government that why it has failed, the reasons for failure to achieve the inflation target, what are the remedial actions that the Monetary Policy Committee or the Reserve Bank of India are taking, okay, as well as in how many months, an estimate of the time period within which the inflation target shall be achieved. So this is the idea. Any confusion, anyone now? So this is it for today. I hope you understood the points. I hope it is clear to you. There is a lot of discussion that is going on in the newspapers regarding the corporate law amendment bill. So now I hope you know that there are certain major changes that have been brought by the government, and opposition is doing its part. It is objecting to certain criteria. That's why this bill has been sent to the JPC, and that is a big thing. And the JPC will soon be releasing its detailed analysis, so that will be important. Okay, but today I have explained you about the corporate law amendment bill. So this is the first question that you have to answer. I hope you will be easily able to answer the question. Consider the following statements regarding amendments to the Companies Act 2013 that has been proposed. Now, which of the above statements is or are correct, that you have to tell. Okay, so I hope you will be easily able to answer this. question. The next question is that as per the Corporate Laws Amendment Bill 2026, which of the statements given below is or are correct? So you have to tell that which of the statements is or are correct. So I hope you will be easily able to answer this question also. Okay. Now, as I have told you already that there is the Recall, Revise, Rise series that we are bringing for all of you. So this is the RRR series, that is the Recall, Revise, Rise series, where I provide 3 MCQs from the recent finance current affairs, RBI notifications, RBI press releases. Okay. So on this topic also that we have discussed, I will bring a shorts that is usually released on Monday, Wednesday and Friday at 8 p.m. where I provide you the 3 MCQs. Okay, so this is the idea. So you can practice more and more MCQs through these shorts series also. So this is it for today. Thank you everyone for joining the session, and do tell me in the comment section below your answers to the homework question. I hope you enjoyed today's session, and the next session will be on the Monetary Policy Committee meeting. That is going to be a very, very important session because this is the first meeting of the new financial year, as well as there is also the change in the base year for the consumer price index. There is the change in the base year for the real GDP. So we will see that what the MPC has to say regarding that. Okay. So this is it for today. Thank you everyone.